From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 17th, 3 p.m. in London, 10 a.m. over in New York. We're 30 minutes into a big volume trading day in the United States. From London, I'm Guy Johnson, Alix Steel over in New York. Welcome, everybody, to Bloomberg Markets. Alex, the witches are driving volume. UMich is about to drop onto the terminal.
UMich, one of my desert indicators. I love this, and we'll get to that in just a second. So quick check on the markets right now. The story, yields. You have a move 3 basis points higher in the 10-year. 136 is where we sit. We're above now that 200-day moving average, but 141 is the 100-day moving average. That's kind of the next key level to watch. Equity still on the downside here, off by 0.5%. Energy, though, on the upside, in part because oil's having a pretty good week, the best run of weeks since early July. We are seeing a touch elevated volatility, still below 20, but the last few days we've seen a lot more volatility pick up. I should point out the energy index is now down 0.3%, but oil is still managing to climb onto its highs as well, as you wind up having all the softness and a lot of movement in the equity market. All right, guys, let's get to those numbers.
Okay, let's break it down. This is September data, remember. Headline number 71. That's up from the previous, but it's below expectations, which was 72. Current conditions at 77.1. That's a dip from 78.5. Expectations, though, go up to 67.1 versus 65.1 last time around. What about inflation?
Yeah, inflation, it feels a little bit like what we saw with retail sales, like coming and bang in line with estimates. We're seeing inflation expectations over the last year, 4.7%, 5 to 10 years, 2.9%. So coming in line, but that doesn't seem to be denting any kind of expectations at this point.
No, but I think it continues to tick higher. So last time around, the 1 year 4.6. This time around, the 1 year 4.7. Just it kind of this story rate of the consumer looking at inflation and being worried about it, I think, is something we're going to have to pay attention to, and central bankers are going to have to pay attention to as well. When it starts to get embedded, that's going to be a factor. Now, energy prices are usually a big component of all of this. Let's break it down. What are we to say when we have Richard Curtin from the University of Michigan ready, standing by to talk to us about the data? Professor, what should I be taking away from these numbers?
Oh, good morning. I think the basic story here is that consumers were slightly more optimistic about the future, but not so much. They still expect the economy to struggle through the end of this year with the Delta variant, and they expect slight increases in the employment rate. But what we really see is the impact of inflation. Consumers now think that buying conditions for household durables are the worst we've recorded. There was only one survey in 1980 that recorded a more negative decline. And the worst declines are all caused by rising prices. People think now is the time to postpone.
So if, though, the expectation index is still holding up, do I read into that consumers don't like buying stuff today, but that they feel okay about it in a year?
That's exactly right. They don't think, they hope that, and actually think that inflation or prices of products will start edging downward, or at least not go up anymore in the year ahead. And so they think that it will be a better time to buy these big ticket items, and especially homes and vehicles, by postponing them into the year ahead, where they might expect some declines, but certainly they don't expect any further rises.
Professor, this sounds like something the Fed's not going to be worried about. Basically, consumers are going to defer rather than spending now. If they were worried about inflation, you would buy now because you would assume that prices would be higher further down the road. That's not what you're saying. What you're saying is the consumer thinks this is transitory.
Right, they do. And if you look at the difference between the 1 year and the 5 year inflation expectation, the 1 year has gone up 2 percentage points more 2.1 percentage points over a year ago, but the long-term rate has only inched up by 0.2%. And so, they think that this is inflation is still well anchored, and they expect a decline in inflation during the year ahead.
I also, the consumers' longer-term outlook for the economy also hit a decade low.
Yes.
Is there anything else aside from the rising prices that could be more endemic that's in there?
The 5-year question really is a good predictor of the overall economy in the future. And I think consumers now judge the economy. They are hesitant to judge the economy favorable because of the vast changes in fiscal and monetary policies that are about to occur. And they don't know what they will do to that. Now, one of the big impacts is on inflation, and consumers, if you believe that the excessive monetary and fiscal policies will cause rapidly rising prices, then, consumers have two reactions to that. One is the old reaction of buying in advance and demanding higher wage increases, but that reaction takes some time to develop, and of course it needs higher long-term inflation rate. The other reaction is to look at what they're complaining about is living standards, and that's real income. And in the past, we focused on the denominator pricing or inflation, but now consumers may focus on the numerator income, and they may expect a higher net income, net of taxes and transfers, because the pandemic, if it didn't teach anything else to consumers about the economy, is that these transfers were very effective in avoiding some of the great disparities among those who have suffered the most. And it doesn't take any stretch of the imagination because inflation and unemployment have always been linked as the two primary problems, that consumers start thinking that the government should add to their spending levels of aid for those who are most affected negatively by the inflation rate, which of course are low-income households.
Yeah, it is regressive. Professor, this time last month, we were all standing here quite surprised at the speed at which the data had come off. The market was expecting something up here. We got something down here, 80, right. 70. Do you have, over the last month, when you've looked at the data from last month, what else have you been able to take away? What else have you been able to deduce from that big miss that effectively we got last time round?
That big decline, I think I mentioned the last time, it was more on emotion than on actual economic data, is because that consumers are so apprehensive still in this pandemic, and they correctly recognize that times were getting worse. And, emotions, one of the signal characteristic of emotion, it makes people act and react faster. It's the old fight or flight instinct. And, they dropped their level of confidence immediately. And, unfortunately, those who thought that this was, an illusory decline and it would soon snap back has not occurred. We are still very close to the low we recorded in the first half of August. And I think, so that's one of the main takeaways, that this shift was because of the anxiety they felt, and it caused them to readjust their expectations almost immediately.
Professor, we really love breaking this down with you. It's so valuable. Richard Curtin of the University of Michigan Survey Research Center. We will see you next month. Guy, what I also found interesting as well is who was seeing the most stress. What stood out is that younger, richer, and more educated households say they're now complaining about rising prices, meaning it's not just the lower income, less educated households. And that sort of, I wonder how then permanent inflation expectations can become when it moves up the wealth chain.
Yeah. I guess my takeaway from what I just learned from the professor, though, was that most people continue to see this as being a temporary phenomenon. Normally, if you were to expect inflation to go up and stay up, i.e. prices are going to continue to rise month on month for an extended period of time, you buy now because things are going to be more expensive further down the road. What he's suggesting is that consumers, and this feels like it stands a little bit in contrast to what we got from the retail sales number yesterday, though Mike's point about it being maybe driven by higher prices is an interesting one in this. But basically, if you were to suspect that you could get things for a better value further down the road, you would wait. Sure. That doesn't appear to be what's happening, judging by the retail sales number. Right. But maybe there's an inflation impact in there that is actually, this is a value thing rather than a volume thing. Which then also goes to the point of, are we going to see some more weigh on growth here, like more pressure on growth? The peak growth story we've already talked about, more pressure there coming off of that. You're seeing equities right down the lows of the session here. You're still having a rise higher, though, in bond yields, which I found surprising. The dollar, though, spiking higher. It is triple witching, that time when traders pay up for hedges. You've got a lot of volatility now, and then maybe around the close. Manish Deshpande, Barclays head of equity and derivatives strategy, joins us next on Triple Witching. This is Bloomberg.
Our data would suggest something a little bit different. I mean, I think people are somewhat protected for a 5 to 10% move, which is why if it gets going, it could be more severe than the typical sort of 10%er. So I think either we're going to get nothing, okay, and maybe money continues to come into the market and we just sort of chop and flatline here, or we have something greater than 10%, because I don't think people are protected for something like that. At least that's what our data suggests. And that's the way we're leaning. So, but either way, Guy, I mean, the risk reward for the index right now, just not very good. And that's why we're trying to, help clients do the right relative value trades and pick stocks.
Mike Wilson, Morgan Stanley chief US economist, speaking to us yesterday, chief market strategist, equity strategist.
Good catch,
talking about, he doesn't do economics, like he does do economics tangentially. Exactly. But what he was saying, so the way I prefaced the question was, the market is paying up for puts right now, and it's paying up a lot more for puts than it's paying for calls, i.e. the market, and this is not the retail side, I'm talking about the professional investors generally are buying a lot of puts. They're paying for them, they're worried, they're basically trying to protect their downside. And Mike's point was, yes, but they're protecting down to around a 10% drop. And what may happen is you get a bigger drop, and that basically blows everybody out of the water, and things start to accelerate and snowball at that point. Now, this is relevant today, Alex, because obviously we've got witching, you've got super strong volume, and it's going to be interesting to see how this all works its way out. But basically, the market is paying up. The headline skew looks fairly even, put-call ratio, but if you take a look at the pricing, that's where the gap emerges.
Yeah, we actually have that chart up right now, and you can see sort of when the line declines, it means the puts are getting more expensive, and you can see that decline occurring. But we're well off where we were, say, back in March. But Goldman says that you could see about $3.4 trillion of equity options set to mature on Friday. I mean, that's huge. That's a lot. That's a lot of stuff that's going to be happening over the next few hours. Manish Deshpande, Barclays head of equity and derivatives strategy, is with us. Hey, Manish, it's good to see you on Friday. What are you making of the options action right now?
So certainly, I think, as you mentioned, the skew is very expensive, and I think it's not just the sort of the low strikes, but I think even if you go down even further, if you take other measure of convexity, sort of very deep in the money puts, or if you look at VIX options, they also appear to be telling us that there is a lot of put buying, even for. So I think there's protection for even deeper sell-offs here. Now, what that typically means is that market makers are short options. And the way that the option dynamics works for them is that to hedge themselves, as the market goes down, they have to sell more. And as they buy, the market goes up, they have to buy more. So they exacerbate the moves. And so what this has meant is that historically, any moves going into the option expiration gets exacerbated. Right? So if it is going down, it goes down more, up, it goes up more. And so I think, obviously over the last few weeks, we have a sort of a softer market. So those moves could potentially get exacerbated a bit more. Again, I don't want to say it's sort of going to cause a crash or anything like that, but incrementally it's going to exacerbate it a little bit more as we head into expiration. And then we could see a bit of a bounce as that pressure abates.
That's been the history over the last few months. 17th, 18th, 19th, whenever it's kind of fallen, those are the lows. Is that what we can expect this time round? Basically, if you are looking at the market from 30,000 feet, this is and you look at the chart over the last few months, is this the moment you want to be stepping in? If you're just stepping in as a cash buyer to buy equities, is today going to be the day once we've got this expiry through?
So everything else being equal, I would say yes. But again, I want to caution that we're not talking about huge effects, right? We're talking about a few percent kind of extra edge that you might have today. Again, and it's not just a question of the last few months, by the way. If you go back 10, 15 years, this has been a very consistent pattern. But again, it's a small effect. But for the long term, we always advise investors to buy or sell, during depending on how the market has been moving into the option expiration.
Hey, Manish, I know we're talking about the professional investors, but I did want to ask about retail, because if we have that kind of 10% drop, what we usually see, our retail investors have been buying more voraciously, and there's some signals that are showing they're in the market right now, but not as much. Like those kind of ETFs that track indices are not having the same kind of volume we might be expecting. Do you have a sense of that part of the market right now?
Yes, and actually that's a great question, because I think it is a little bit confusing when you talk about retail. And so we actually divide retail into two categories. So kind of retail, 401ks who buy through mutual funds or ETFs. So we call that indirect retail, as opposed to investors who are directly buying stocks, right? So to some extent, all these meme investors are not going through mutual funds or 401ks. So the story actually has been over the last few months or the last few quarters is that this mutual fund and ETF flows have been very strong. However, the direct retail who directly invest in stocks, they have been the ones who have been selling. So their selling has actually exacerbated. At the same time, what you see is that real money investors, so pensions and endowments, they have also been selling into the rally. So it's a bit of a mixed picture. But the direct retail investors who are presumably much more active usually tend to be contrarian. So they buy when the market goes down and they sell when the market goes up.
How do buybacks confuse what we're going to see in the options market?
So buybacks are, of course, more of a long-term issue. It's not really relevant for just today. But what we have seen is that buyback, if you look at the dollar value of buybacks, that has rebounded. Obviously, because to conserve cash, companies really stopped buybacks last year. The dollar value has rebounded. However, given where the level of the market is, the amount of buybacks do seem a little bit less. So historically, if you look at buyback yield, so if you look at total amount of buybacks divided by market cap, that has hovered to sort of 3-4% or so. Now, that is much, much lower than compared to what it was for the last few years. So yes, companies are slowly coming back and buying back, but given where the market is, it doesn't appear to be as strong as an effect.
Just wait if we get those buyback taxes. That's a whole different story there. Hey, Manish, before we let you go, correlations, are we moving as one story right now in the market, or are investors comfortable buying individual stocks right now?
So, no, I think so. If you look at correlations, actually sort of what's been happening in the market, what the options are pricing in, they are not extremely high. But the reason for that is that really there is one factor which is moving on. That's one factor that rules them all right now, which is if you want to call it the COVID factor or the reopening trade, however you want to call that. That is really driving everything. But what that means is that there is a lot of dispersion, because obviously, some stocks are benefited and some stocks get hurt by the reopening trade. And so that's why overall for the entire market, there is a lot of, the correlation is not very high, but but there is one factor which is driving the market.
Manish, great stuff. As ever, perfectly timed as we watch what is happening on the markets. We'll see how volatile today's session is, how we work our way through this. Volume already significantly higher. Manish Deshpande of Barclays. Great stuff. Thank you very much indeed. What are we going to talk about next? A potential ETF giant. Invesco in talks with State Street Asset Management arm about a possible merger. Invesco traditionally very active. This is obviously a huge nod towards passive and ETFs. This is Bloomberg. The consolidation continues. Two of America's largest asset managers said to be in talks to merge. One active, one passive. Dave Wilson looking at the tie-up. Dave.
Well, what we're talking about here is the possibility that Invesco may get together with State Street's asset management arm, State Street Global Advisors. Now, that doesn't exactly come from nowhere. I mean, we reported last December that State Street was looking at alternatives in the asset management business, even considered getting together with Invesco then. Didn't happen. So now you have this possibility that we are indeed going to get a deal. And when you look at sort of the exchange-traded fund industry, which in fact both companies are in, you can understand why they would be interested in getting together. Because basically it's a two-horse race at this point. You have the iShares unit of BlackRock and you have Vanguard. And State Street is a distant third, Invesco is fourth, all in terms of assets under management. So if you put the two companies together, you would have a larger number three, perhaps a more competitive number three. I mean, let's not forget State Street has the S&P 500 spiders and other SPDRs as they're defined, and Invesco has the QQQ, one of the biggest ETFs behind the SPY, which is that S&P 500 spider. So, you know, you are talking about putting together, you know, some fairly large companies in this industry. Yeah. And in terms of understanding why, Invesco hasn't even managed to keep up with State Street over the last 5 years. And, you know, it was about a year ago that you had an activist investor step in, Nelson Peltz and his Trian Fund Management, which is now the fourth largest holder in the company. And back, you know, a year ago when they disclosed their investment, you know, Peltz was talking about how, you know, Invesco needed to get bigger and to compete with the likes of BlackRock, and certainly putting it together with State Street Global Advisors, you'd have a bigger organization. And that really shows up in terms of, you know, numbers when you look at asset managers globally. You know, State Street number 5 on the list would actually vault to number 3 when you add in Invesco, which has about $1.4 trillion under management.
Yeah, it's a great bar chart right there. All right, Dave Wilson, thank you very much joining us. No doubt, though, that active versus passive conversation is going to be coming up, particularly as we come out of COVID. Also coming up, President Biden's tax plan and the impact on U.S. companies. Kristen Bitterly, Citi Private Bank Regional Head of Investments for North America, joins us next. What does it mean if you want to buy back stock? What does it mean if you're going to see a corporate tax rate of 26%, not the 28%? This is Bloomberg.
For a long time, this economy has worked great for those at the very top. While ordinary, hardworking Americans, the people who built this country, have been basically cut out of the deal. And I've said this from the time I announced I was going to run. I believe this is a moment of potentially great change. This is our moment to deal working people back into the economy.
That was President Biden, of course, speaking about his economic agenda yesterday, and the House Ways and Means Committee already approved part of his tax agenda that would help pay for the largest social expansion in decades. The big stumbling block in the Senate is SALT. Bloomberg Washington correspondent Emery Hordern joins us now. Senator Manchin and President Biden met. Nothing really came out of that, right?
Yeah, Axios has this report, Alex, that Senator Manchin was unable to be persuaded by the president in regards to the top-line figure of $3.5 trillion. And even when the president pushed and said, well, what if this means that potentially we won't get bipartisan infrastructure, that hard infrastructure plan, it doesn't seem like Senator Manchin was budging. He also met with the other moderate senator he has to get on board, which is Kyrsten Sinema. And she's been apparently running her own spreadsheets, according to reports. She also is uncomfortable with that $3.5 trillion top line. What's so important about these senators is that the president cannot lose their vote. In the House, it's a little bit more of a wiggle room. They can lose 3 votes. But in the Senate, they need every single senator to sign up for this, or he cannot get through his economic agenda.
Hat tip to my good friend Hans Nichols for that story. AMH, let's talk a little bit about, I think we're going to need to start getting a little bit more granular in terms of the way that corporate taxes need to be analyzed. We are now expecting corporate taxes to go up, 25, whatever the number is, where we're going to land. But we've also got other taxes that are going to hit different sectors of the US economy differently. For instance, what I'm trying to understand now is what does like foreign earnings taxation look like? All of these kind of other little satellite elements around this sort of corporate tax policy that will affect different sectors in different ways. What do we know about the other taxes that could potentially be coming as part of this package?
Well, broadly, Guy, you're right. You can see the direction of travel in terms of higher tax on the wealthy, higher tax on corporations. There's two sectors I would say to hone in on. One is the fossil fuel and the other is pharmaceuticals. So fossil fuel companies, a lot of their or all of their foreign income, that revenue, has been exempted from taxes. Now in the United States, they would, under this plan, have to pay taxes. There's also something in the United States called a super fund. This was created to make sure that you had the money on hand to clean up waste issues and waste disposals. The Democrats want to extend that to 2032. And our analysis is that means that these chemical fossil fuel companies can end up paying some $38 billion in more taxes. And then when it comes to the pharmaceutical industry, now we need to see if the Democrats are able to agree on this, but there is this debate on whether or not the U.S. government should be negotiating with pharmaceutical companies to lower drug prices. And then the second follow-on with that would be that if they don't negotiate a lower price, they can then get fined for it, in a sense. They can then face taxes for it. So those are two industries I would focus on. And then, of course, the big winner will be anything green, right? The green companies, clean energy companies, they could potentially get a lot of tax breaks. And then the follow-ons from those companies. So if you're a consumer and you go out and buy an EV, you could potentially also get tax breaks, which, Guy, you're very familiar with in Europe.
Yeah, that's been a phenomenon over here for quite a while. I think the debate needs to get a little bit more nuanced now. We're kind of dealing with the tax story. We still don't know what it's ultimately going to look like. But I think from a sector story, I think, Alex, it's going to become fascinating. Anne-Marie, great stuff. Thank you very much indeed. Absolutely perfect. Bloomberg's Washington correspondent, Anne-Marie Hordern, joining us from D.C. And I think this is where the debate now is going to go, Alex, into those specific sectors. And from an equity point of view, therefore, you would have thought the debate needs to get a little bit more nuanced.
Yeah, I'm also, yes, the nuanced, and also, you take a look at, say, the capital gains tax rate. That's proposed to go up 25%. And I just wonder how that will shift any kind of selling in the short term if it's not a retroactive kind of tax. So there's the macro part of that, and then there's the individual sectors too.
So so I was trying to think about this morning. If it's retroactive, does that mean it actually has no effect? Because effectively, you've already gone past the point at which you can sell
right. So
to protect
there's no
yourself.
point for
There's
any
no
sort
point
of
anymore.
Front running it.
Yeah.
Possible.
Absolutely. If it's not retrospective, then there could be much more of a market implication. So I think all of this detail is now where we need to focus our attention. We've got a perfect person to talk to about that. Let's bring in Christian Bidley, Citi Private Bank Regional Head of Investments for North America. Christian, let's start off kind of big picture. When we got the Trump tax cuts, the market kind of didn't price those in right until the last minute. Once it became real, the market aggressively priced them in. At the moment, it kind of feels as if the equity market isn't pricing in the possibility of tax hikes. We were talking to Mike Wilson about this yesterday from Morgan Stanley, and his view was when it becomes real, the market will kind of go from 0 to 100 and price it in super quick. Is that your kind of perspective as well?
Yeah, absolutely. And this is something that we've seen in the past, to your point, and something until it's actually known what's going to happen, it's really hard to reposition your portfolio on the basis of something that could happen. And so one of the baskets that we actually track at Citi is we look at those tax beneficiaries. So this is more on obviously the corporate taxation side, but we look at those companies who had a big benefit in terms of the tax cuts several years ago, and those ones that actually would stand to have a risk in terms of their profitability looking forward. And when you look at that long short basket, it hasn't moved at all, even over the past several weeks. And so that is something I think the most important thing is it could actually create some volatility, obviously, going into year end based on what you were just discussing. Is it retroactive? Is it not? That could have a lot of individual investors making decisions. And then which of these sectors are actually most impacted?
So, I mean, it would be easy to say it would be as simple as like, go ahead and sell the tax winners from Trump's tax plan and then buy the ones that are going to feel the reverse, right? Is there one sector that you see that is specifically on the docket or on the chopping block when it comes to this particular tax plan in a way that we haven't seen in the last few years?
I think that the issue that we have in terms of making a lot of these decisions and how the market is going to react is you have to look at this as one variable amidst a lot of variables, right? So the interest rate environment that we're in and the potential movement of rates is going to drive some sector rotation. We're also looking at, for example, just in terms of Delta and that kind of COVID cyclical, COVID defensives. So I think right now what our strategy has been from an equity perspective, which addresses a lot of these concerns, whether it's inflation, taxes, the pandemic, is actually leaning into quality. So this becomes an environment of security selection becomes really important, and also focusing on quality companies that have really strong balance sheets, that have been consistently able to grow their earnings and consistently able to grow their dividends. So look at a portfolio strategy that actually addresses a lot of these concerns to get through the next couple of months and actually into the next couple of years.
When you look at what is, just to come back to the kind of sector by sector analysis, the healthcare sector obviously has huge foreign earnings, as does the tech sector. The tech sector as well has seen huge gains, just from a share price point of view.
Yep.
Does the latter factor come into play here?
So when we look at the actual sectors that are expensive, and this is something that becomes challenging from a portfolio allocation standpoint, absolutely, is so look at the rally that we've seen and the share prices. So maybe we start with tech, right? And say the share prices that we're seeing right now have actually been legitimized, right, by really strong corporate profit, by strong corporate profits and earnings. And so when we see, even from pre-COVID levels, those increases of 30%, you see some really, really strong earnings. I think the question right now is really driven by what is it meant going forward, right? So bringing this back to, again, taxes is part of it, but bringing it back to the earnings discussion, both in terms of which companies, which sectors have that ability to grow their earnings. And while that's coming down, we're still looking at 7 to 8% over the next 2 years, which in any other kind of normal market would be healthy.
And speaking of, you have House Majority Leader Steny Hoyer saying that they're going to vote on that bipartisan infrastructure plan September 27th, so like inching towards that in some capacity. Hey, Kristen, last question for me. The Senate, some individuals in the Senate are trying to push a tax on buybacks, corporate buybacks. Corporate buybacks have been a huge support for the markets. Do you have a base case for like what happens if that goes away?
So we don't have a base case in terms of if that goes away. It has been a big support. I would actually say in terms of looking on a relative basis, we've seen that in the US market. We've also seen that as a big case for European and UK equities as well in terms of driving flows into that region. So I think it's been a support of the market. It's been something, again, that these quality companies have been able to actually drive. But at this point in time, we're not making any type of portfolio decisions based on that.
All right, Kristen, thanks a lot. We love having you on. Kristen Bitterly, Citi Private Bank Regional Head of Investments for North America. Thank you so much. All right, coming up, what Wall Street is hoping to get from the next New York City mayor. I cannot tell you how important this is if you live in New York City. It's an exclusive with Eric Adams, New York City Democratic mayoral nominee, coming up next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Thomas Petterfy, the Interactive Brokers founder and chairman, at Bloomberg TV, 1:30 p.m. New York time, 6:30 p.m. in London. This is Bloomberg.
We're about 6 weeks away from the New York City mayoral race, where Brooklyn Borough President and Democrat Eric Adams will be running against Republican radio personality Curtis Silva. Now, Bloomberg's David Weston has an exclusive sit-down with the Democratic nominee. David?
Thank you so very much, Alex, and thank you, Mr. Eric Adams, for joining us today. Really good to have you here.
Thank you. Good to see you.
You can imagine at Bloomberg, there's a lot of concern about the business community, about Wall Street, and the relationship with New York City and the mayor. It hasn't always been happy in recent years. You've said you want to change that. How would you change it?
Well, first thing, we must hit reset. And I have been spending the last few years, probably 2 years now, and just really speaking with my business leaders, hearing from them, and not trying to interpret from my point of view what they need to do business in the city, but to find out from them. And what I've heard over and over again in all of the meetings, public safety. Eric, we know how to run our business, but we want to do it in a safe environment. And so from day one, I have to turn around this crime issue that we are facing.
So are you talking directly with some of the leaders in Wall Street? I mean, do you talk to the heads of the big banks and they tell you what they need?
Yes, I've communicated with the top end of everything, from those who are part of our major financial institution, and hearing from them and CFOs and finding out what do we need to create an environment in this city that's not too affordable, too expensive, and too bureaucratic to do business in this city. And I say all the time, cities are made up of agencies. And if those agencies are not welcoming to business, to file permits, to start your business, then you're not going to have a welcome feeling in your city, in the Empire State.
But is the number one thing you hear from these business leaders, leaders of the financial community, we need the streets to be safer than they are right now and feel safer than they are right now? And if so, what do you do about that? I mean, after all, you are qualified. You're a former captain of the New York Police Department.
Yes, and you do hear that. Because remember, this is a city that really our trademark is the fact we can move large quantities of people during our transportation system. We have the best transportation system on the globe. But who wants to be on the subway system where not only if you are physically attacked, but you're reading every day about an attack? Because perception is reality. So we're going to have a safe subway system utilizing the manpower of the transit police officers that are there. But we're also going to make sure our streets are safe by targeting gun violence and gang violence in the city. What happened the other day in Midtown, where a person was dining and they were shot because someone tried to rob them at their dining table, that is unacceptable in the city. Or having a 3-year-old shot in Times Square. Who wants to be a tourist in a city where you believe you're going to be endangered?
Do you need more cops?
No, we don't. We have to better utilize the police officers that we have. I believe we have failed in the deployment of police officers in the city. And for the most part, because remember, we've never had a mayor that understood that important entity, the foundation of our city. I'm the first mayor that really understands policing. Historically, mayors have turned their police department over to the commissioners. I'm not going to do that. I'm going to create a police department where my police officers are going to know I have their backs, but also they're going to ensure that they understand the nobility of public protection.
What about having their backs? Because one of the things that we do hear from people, including Ray Kelly, former police commissioner I've talked to, says part of the problem with the New York City Police right now is we've put too many constraints on them. We're too concerned about their behavior on the street, and in fact, we've really kept them from doing their jobs.
Well, think about this for a moment. A police officer has an authority that no one else has, not even the President of the United States. They can take life and liberty. So we have to have proper oversight. But proper oversight should not be demonizing those men and women who put on that uniform and protect us every day. And we could have the right level of the justice we deserve and the safety we need. And I'm going to bring that to the city of New York.
Can you do that and not have some of the abuses that unfortunately we've seen, not just in New York, but across the country?
Yes, you can. I believe we wait too long to get rid of the small number of police officers that don't really respect what it is to wear that badge and uniform. And once you send the right message with the right police commissioner and chief, you're going to see a change in the dynamics of policing.
Can you do that with the police unions?
Yes, you can. You sit down with them. I know all the heads of all of the police unions. I have communicated with them, and I believe it's time to hit reset and change the dialogue. You know what's happening right now? The bad guys are watching us squabble with each other. It's time for the good people of the city to understand we need each other and we can build that proper relationship.
Let's talk about the New York City economy. It's certainly taken a blow from this pandemic. Where do you think it is on the recovery road?
I believe that we're starting out, and of course, the way we get our economy and turn it back around, as I stated, to deal with public protection, but also get COVID under control. And that includes getting our offices open. I believe the state and city must come up with clear guidelines of what are safe office environments so that we don't have frivolous lawsuits if someone contracts COVID-19. so that our businesses can feel comfortable about getting people back into the office spaces. I need that accountant back in his office so he can go down to the local restaurants, get the business travelers here. That's the ecosystem that we need. It doesn't exist, and it won't exist if people remain home.
Well, that's one of the key questions, obviously. If you walk around the streets of Manhattan right now, you're struck with the fact that it's come back some, but it's not all the way back at all. And in part because, as you say, office workers are not back in. Where are we in the process of bringing them back in? What can you do to encourage that?
Well, I think that some companies have done a great job. Related, I believe they're up to about 90% of their companies that are back. I look at what RXR is doing and some of our other companies are doing. We need to tell our employees, hey, let's put our toe in the water. Then put a foot in, and now we can immerse our entire bodies. There's a reluctancy to come back. There's a fear of COVID and now the Delta variant. But this is a city where there are 10 million dreams vibrating. We are about to wake up and ignite all of those dreams, and we do it by giving the comfortability of public safety, safety from COVID, and ensure that people could come back into their office spaces.
Okay, perfect. How do you have that public safety and safety from COVID in the subway? Because a lot of those office workers take a subway to get to work, and right now a lot of them are very concerned about taking the subway, first from COVID, but more recently from some of the attacks in the subways. What do you do about that?
Yes, we've overcome the fear around COVID. People have become comfortable with putting on their mask, following as much as possible the social distances. I believe that New Yorkers have adjusted to the COVID aspect. It is the lack of safety that I hear far too often when I use the subways as well. And what we need to do is zero in on those individuals who are dealing with mental health illnesses and never receive the proper services. I would reinstitute the New York City Transit Police Homeless Service Outreach Unit, partner them with mental health professionals, and be proactive of getting people out of our system that is creating the actual and perceived fear that we are witnessing.
Talk to us about employment. The unemployment rate, last time I checked, of New York City was about double the national average right now. What can we do to get jobs?
When you look at it, we're dealing with about a 10.2 unemployment, and I think the number is actually being reported lower than what it is. September is going to reveal a lot to us. I think many people have stopped looking for jobs, and we need to reignite our system. I want to put in place an unprecedented relationship with our business community and those who are seeking jobs. We want to centralize a one application process where whomever is looking for a job would fill out one application and have our business leaders list in a database all of the available jobs so we can start partnering and matching individuals together. I had a great conversation with the partnership and other businesses in this city to talk about how do we create that synergy to prepare people for this employment.
Which leads us to the question, we've talked about what the business community wants from you. It sounds like they've not been shy at saying what they want. What do you say to the business community about what you want from them if you become mayor?
A combination. And, I must say the level of excitement from business leaders, I did not have to reach out and find them. They found me. They said, Eric, we want to help. This is our city, and we want to help. Number one, we need those jobs that are available, a centralized database to match it with those who are seeking jobs. Number two, they're amazing R&D. I want my business leaders to look at the historical problems in our city and say, let us use our research to help come up with solutions. Like the feeder of crime in this city, I believe, are those who are not receiving proper education, even dyslexia. A large number of inmates in Rikers Island are dyslexic. Why can't we use our tech companies in the city to come up with ways of screening dyslexia early so that we can give the proper resources to family? I want them to look at our, I call sick care system. It's unsustainable. Why can't we find the technologies and the use of modern medicine to help have a great health and hospital system? So I'm asking them, use their abilities of research, their abilities to get things done to help us have a city that's a smarter city where we can end the inequalities and inefficiencies.
And finally, this is a great city. I think everyone agrees it's a great city, even if they have problems with it. Are we on the way back? We had Broadway reopened this week, which gave a lot of people encouragement. We need tourists, for goodness knows. That's an important part of the environment. Give us a sense of the rejuvenation of New York. How can we come all the way back? Can we come all the way back?
Oh, yes. Actually, we never left. New Yorkers were really waiting for the opportunity. I am excited about the possibilities. This is our Pearl Harbor moment, just as my moment of 9/11, our babies today, they have their COVID moment. But history has shown never count out America, and when you don't count out America, the reason is that you never counted out New York. The resiliency is in our DNA. This is an amazing city. I like to always borrow from a Brooklynite, the owner of Snapple. When he said it, I say it. We're going to come back because we're made up of the best stuff on earth. We're New Yorkers.
Mr. Eric Adams, thank you so very much for being with us. He's the Brooklyn Borough President as well as the New York candidate for mayor. Back to you.
All right, thanks so much, David. Really appreciate it. That was David Weston with New York City Democratic mayoral nominee Eric Adams. I got to say, as one who lives in Brooklyn and grew up in New York City, I totally feel that New York pride, guy. We definitely have that. It's a thing.
Absolutely, 100%. This is a city that's been through so much and continued to deliver. But there are new challenges at every turn. Crime is definitely one of them. We were just hearing about that. You've been talking about SALT so much over the last few days and weeks. I think that kind of draws a line down to what is happening in Washington right now. You look at the tax story, people moving to Florida. There are new challenges, there are different challenges, but the dynamism is always there. That's the thing. If you have that dynamic kind of ability to adapt to change, you should be all right.
Yeah, I just think that well, I guess you could say this for many different times, but I think that the change that we're looking at right now in terms of the work from home thing is going to be a longer term issue because, like you heard Eric Adams say, you need that person to come in and go to work, that tax accountant, so that he can go buy lunch at the local store. And if you don't have that, or you only have it 50% of the time or 3 days a week, how do you recalibrate that? That's going to be a very big long-term effect for a city like New York, even if all the tourists come back. I mean, it is in part like a ghost town in New York City right now, like where we are right in Midtown, where the Bloomberg building is. And I think that that's going to be something to be reckoned with.
We don't know yet. We don't know. The last 2 weeks have seen a huge influx of people back into London. Are those people going to be coming back 2 days a week, 3 days a week? In a year's time, are they going to be back 5 days a week? I don't know the answer to that yet.
It's a different vaccination thing over there. And there you don't have Florida and the different tax regions in the same kind of way.
No, but we have Paris and we have Brexit and all kinds of other factors we've got to deal with as well. These cities, the aggregation has been important. Does technology change that? We'll find out. European close is next. We're going to talk about iron ore. This is Bloomberg.